Question 61. Which of the following is or are least likely exchange-traded derivative instruments? So we've got futures, forwards, options, and swaps, and then different combinations of these four as our answers. So the key here is going to be customization versus standardization for the different types of contracts. And so our more standardized contracts are going to trade on exchanges, and the more custom are going to be go over the counter. So futures, these are standardized, so they will trade on the exchange. So we can go ahead and cross off one, and we can then go in here and cancel out any answer that has one in it. So right in there, we could go ahead and choose B, but let's just take a look at the rest of these to make sure we're correct. Forwards, these are going to be used by institutions and are definitely going to be more custom, so they'll be OTC. Options, like futures, are going to be more standardized in the contracts, so they'll be traded on exchanges, and then swaps are going to be like forwards in that used by institutions and to be more customized to the specific situation that they need it for, to hedge or put on whatever risk they want. So 2 and 4 are not exchange traded, so that's our answer there, B, 2 and 4. Question 62. Which of the following is least likely characteristic of exchange traded derivatives markets? So we've got A, transparency. They're traded on exchange and very liquid in this case, if they're exchange traded. There's also going to be no counterparty risk since that's going to be assumed by the exchange. So transparency likely is a characteristic of exchange traded derivatives, so we can go ahead and cross that out. Lower degree of regulation and oversight. If they're trading on an exchange, there's actually going to be a higher degree of regulation. This would be describing OTC markets. So this is probably going to be our answer, but let's make sure we can go ahead and rule out C. Standardization of contract terms and conditions. This is also a characteristic of exchange-traded derivatives markets. So we'll go ahead and rule that out as well. Go with B. Question 63. Which of the following derivative contracts will most likely expose the contract owner to default risk? So we've got futures, forwards, options, and swaps, and then different combinations of those in our answers here. So the key here is that default risk component. So with the default risk, the main thing that we'll be looking for here is whether the derivative contract is exchange traded or not, because exchange traded would indicate that the exchange is taking on the counterparty risk, so there'd be no default risk in that case. So futures, these are traded on exchanges, so they won't be exposed to default risk, so we can cross one off, and then we can also go in here and cross off any answer that has one in it. So it looks like we'll be going with A, but let's just make sure that makes sense after looking at the rest of these. Forwards, these are going to be traded over the counter, or OTC, and so we will be exposed to counterparty risk or default risk, since we're going to be contracting directly with the other counterparty rather than going through the exchange. Options are going to go through the exchange, so we can cross that off as well. And then swaps will be similar to forwards in that we'll be contracting over the counter directly with the other counterparty, so they could default. So that leaves us with 2 and 4 left, and it looks like answer A is right. Question 64. Which of the following statements is or are most likely to be correct regarding derivatives? So we've got 3 statements here, and then we need to determine which of them are correct, so then we can choose our from our different answers down here. So as we've kind of talked about before, if you see one of these statements in every single answer, you can shave a little time off on the exam. So we can see statement 3's in there, so we can go ahead and cross that off. We'll still go over it for education purposes, but just a little tip there. Okay, so statement 1. Derivatives are similar to insurance in that both allow for the transfer of risk from one party to another. This is correct. So an example here is if you owned a stock and then you bought puts on that underlying stock, or if you own the index and bought puts on the index, you're basically transferring the downside risk there to the other party by paying a premium. Since if you're buying the put, you have the right to sell that stock at the strike price. So this is going to be a correct statement. Statement 2, derivatives derive their performance from the performance of an underlying asset. This is also true right there in the name. It's a derivative. It derives it. And so this is basically the exact definition of a derivative. So 1 and 2 are correct. And then, so that would lead us to be able to go with C here. So since we know 1, 2, and 3 are correct. But let's just take a look at 3. The writer of an options contract is referred to as short because he or she holds a short position. So with the short call, you want the stock price to go down so that your shares don't get called away. So that's just one example there. So we go with C. 1, 2, and 3. All 3 statements are correct. Question 65. Which of the following is or are most likely to be characteristics of alternative investments? So we've got low level of regulation, high use of leverage, and high correlation to systematic risk as our 3 characteristics, and then we need to choose which combination of those are characteristics of alts. So looking at statement 1, low level of regulation, this is a characteristic of alternative investments, and it's typically the case because alts are used and sold to high net worth individuals, which would be accredited investors or qualified purchasers, or institutions. And so at that level of net worth, it's kind of assumed by the SEC that they have enough sophistication or money to kind of withstand any substantial blows that may come from these potentially higher risky and more opaque strategies. So 1 is a characteristic, so that'll be good. 2, high use of leverage. This typically is also a characteristic. Looking at private equity or real estate, for example, they're buying businesses or real estate using leverage, and then using the cash flows to kind of pay down the debt over time and add value to sell the business or real estate at a higher value. So this is usually a characteristic as well. And then 3, high correlation to systematic risk. Some may have this, but really the point of alternative investments is to have low correlation to systematic risk. Systematic risk is market risk. And so we want our alternative investments to generally have low correlation to that type of risk to provide us with those diversification benefits. So we're going to be looking for an answer with 1 and 2 in there and not 3. So it looks like we can go with A. Question 66. Which of the following is least likely a terminology used to identify venture capital investment at different stages of a company's life? So we've got A, formative stage, B, middle stage, or C, later stage. So no real advice here other than just needing to memorize the 3 stages from the curriculum. I think a good way to do that is using flashcards. So those 3 stages are formative, later, and mezzanine. So our middle stage is not a terminology used, so we'll go with B, middle stage. Question 67. XYZ hedge fund charges a management fee of 2% based on assets under management at year end and a 20% incentive fee. The initial investment is $125 million and the fund earns a 40% return in its first year. What are the fees earned by XYZ hedge fund if incentive fee is computed based net of management fee? Assume management fees are calculated using end of period valuation. So let's pull in our components here. So we're going to be looking at the management fees as well as the incentive fees in order to get that total fees that the hedge fund earned. So starting with that management fee, we're calculating based on assets under management at year end. So we're going to need to take that 125 million and multiply it by the return in order to get the end of year AUM. And then we simply just multiply that by the management fee of 2%. So we get 3.5 million for that. And we do this first because we're going to be doing the incentive fee net of the management fee. So we need to have that in order to calculate incentive fees. So incentive fees then are going to be based solely on the performance component. So we need to figure out how much the hedge fund earned of that year-end value. So we take the 125 starting AUM times the 40%, and that gives us the millions of dollars that the hedge fund earned that year. And then we're simply just subtracting out that 3.5 we got in the first portion of the answer. So that gives us the dollar amount we need, and then we'll take 20% of that to get the incentive fee, and we get 9.3 million. So then you're just going to add these two together, gives you 12.8 million. We'll go with answer C. Question 68. Stocks of Orange Corp are trading at $60 and the strike price of 6-month put options is $40. Given the price of the 6 months put option on Orange Corp is $2 and the risk-free rate is 8%, the price of the call option is closest to. We've got 3 answers here. So we're going to be using put-call parity formula in order to solve this. So we're going to be solving for the call, so we're going to bring this over here in the formula, and then we're pretty much just going to plug in our numbers in order to get the answer. So the stock is currently trading at $60. This will be our S variable. P is going to be that $2, the cost of the put, and then X will be our strike price of $40. And then we'll discount that back at the risk-free rate of 8%. And our T is going to be 0.5 since it's a 6-month put option. So I've got that right here. We'll pull that in. And this is pretty much what we just described. So we've got 60 plus the 2 minus 40 over that risk-free rate discounted back, and gives us 23.51. So we will go with answer A. Question 69. Which of the following is or are least likely accurate regarding leveraged buyouts, LBO? So we're going to, 2 of these statements are going to be accurate and describe LBOs, and then 1 won't, which is what we want to choose. A. In an LBO, the acquisition of a target company is funded through debt. Yes, this is certainly a characteristic. It's right there in the in the description. It's a leveraged buyout, meaning we're using leverage to buy out the firm. So we can go ahead and cross that out. B, in LBOs, the acquiring company's cash flows are used to service the debt. So it shouldn't be the acquiring firm cash flows used to service the debt. When companies are being targeted for this, the targeted company are expected to service the debt. So this is probably going to be our answer. And just think about it this way: you wouldn't want to be having to pay out of your own pocket to service the debt. You're taking out the debt so that the target can pay that off and increase the value of the firm. After buyout, the target company becomes or remains a privately owned company. LBOs are typically done by private equity firms, which are private, so we can go ahead and cross out C as well, and confirm we'll go with B. Question 70. According to the put-call parity, a long position in a put option can be replicated by going... We've got different combinations here of long or short the call, long or short the underlying, and long or short risk-free bond. So really we're going to be we're just going to be looking at the put-call parity formula here, which we should be familiar with at this point. And since we're looking at the P, the put, we need to just rearrange this formula in order to do so. So when we rearrange the formula, we get something that looks like this. So we get P equals the call plus the risk-free bond minus the underlying. And so once we rearrange the formula, whether it's positive or negative is going to indicate whether we are going long. So if it's a positive value, we're going to be going long that portion. If it's a negative value, we'll be going short. So in this instance, we have a positive C, so we're going to be long the call. So that leaves us A and C as options here, so we can go ahead and cross off B. And then we've got positive on the risk-free bond portion, which is our strike over the discount rate. So we'll be long the risk-free bond, so we've got that here. So we can go ahead and cross out C as well, it looks like, but let's just make sure we've got it right here. So then we're minus S, which is the underlying, so we're going to be going short the underlying, and A, we can see here we've got short the underlying. So we're going to go with A.